Okay, thanks for having me, and thanks everyone. I'm going to do my best to speak into the podium mic, which is not built for my height. So I want to start by just giving you a sense of what USIF is. So I've been on the team now for about 3 years, and we are a nonprofit organization based here in Washington, D.C., but we are a membership organization for financial services firms and organizations around the United States. So that includes pension funds, large and small asset managers. It ranges from data providers that you might know like Bloomberg or Morningstar to individual financial advisors. What we try to do for the space is create a convening, both virtual and in person each year, for various aspects of sustainable investment. And the reason I titled this Sustainable Investment is there's been a widespread shift in the United States. So what I'm going to do, hopefully in the next 11 minutes, is give you a sense of what's happening, what has happened over the last 25 years, but in particular the last 10, where we see areas of continued advancement which excite us, and then I'll bring it into shareholder engagement in particular, and why we think that is maybe the most important space, certainly because of some threats against it, but an area of focus for the next few years. Just to give you a sense of what USIF does, in my role as Director of Education, that might mean going into a distressed credit asset hedge fund and helping them integrate or understand how they might integrate environmental data points into their investment selection process, to speaking with undergrads at universities that are still trying to figure out what they want to do with their lives, and everything in between. And so what we do is build guides that range from guides for asset owners like pension groups. We're explaining how they might best incorporate practices that have helped other organizations that have done it for years, down to individual investors, how they can start to do this with their own money outside of what might be in a retirement account or pension fund. And so without further ado, I want to jump into what the space is, because if you go back to, let's say, the mid-'80s, it was described as SRI, socially responsible investing. And the acronym has started to change. So one of the things that I wanted to share with everyone was, even in the time that I have been with USIF, what was once the Social Investment Forum is now the Forum for Sustainable and Responsible Investment. All of the other SIFs in the world, there you will find them in the UK and Japan and Canada, they have all changed their names to Sustainable or Responsible. So I wanted to share that because it's a good sign. What it is indicating is that it's becoming more pervasive, it's more, we hope, inclusive, meaning that traditional asset managers that maybe had no expertise in the space or maybe didn't have any values orientation to what they were doing are still incorporating the things that are important to those of us that have been doing this for quite a long time. This chart, which is probably impossible to see after 10 feet away, points to different categories. The reason I have this up here, I think what will help you think about shareholder engagement is that there are going to be data points for active stakeholders that they approach a company about, and they will range from environmental issues to social issues to corporate governance issues. And within those three letters, ESG, there are multiple areas that you might approach these companies on. The point of shareholder engagement is to help a corporation that you own shares of hopefully perform better or become more sustainable in its business practices, which then are positive to the investors. And so these areas of interest have varying data points. The amount of data that has now been cultivated by data providers like Bloomberg and Morningstar that I mentioned, or MSCI, down to asset owners like a pension fund where it has particular areas of interest and they want to talk to a company and say, hey, this is of concern for us for whatever the reason might be, or subset of reasons that it might be. As you think about the space now, and you will still hear socially responsible investing, we certainly use that in our community, but now many people are using sustainable, responsible, and impact investing because it encompasses, well, first of all, it's the same acronym, which is great, but it also encompasses every single form of investment in the United States and actually globally as well. ESG is essentially the data that everyone is using to differing degrees. It's really no different than financial data. It's literally no different than the financial data sets that people were using since the beginning of professional investment management. What we're finding is the world has become less tangible. And so if you look at the S&P 500 500 or the Dow from 20 years ago to today, there is less manufacturing. There's more, I'll pick on a few companies, but Facebook is one that is in the news quite a bit for different areas of concern, whether it's privacy breaches or the fact that they don't have a tangible product. And how do you assess risks to somebody that doesn't maybe have the traditional manufacturing stream or employee headcount or user base? ESG helps you uncover potential areas of risk that are not necessarily accounted for on traditional balance sheets. And I would say socially responsible investors have been considering ESG data since the beginning. They maybe didn't call it ESG, but they certainly were. And what we're finding is there's widespread adoption of this additional data because it's helping all professional investors, whether they're individual or running a pension and everything in between. The last bit of this, and I think this is obviously vital to today, but something to think about as you go back home and do your own research or continued reading if that's of interest, is active ownership. So what do we do as shareholders, whether we are individuals or a large pension? How do we engage with these companies, and what happens when they try to change the rules, which is what's happening right now and of great concern. So I'll explain that a little bit later, but I just want to show you, which is hopefully a little more legible than the last chart, a few areas so you can break down where these ESG criteria or data points might fall for how a professional investor might approach a particular issue. It's pretty self-explanatory, but it maybe gives you a better framework. And what I will say is, for those of you that do have interest in more on this, if you go to the USIF website, there are lots of great resources in the space, but we try to be an aggregator in some ways, and then in others put together original pieces. You can dive into any of these particular issues and figure out what it means to you, and for a company, what the materiality of each issue might mean, because worker health sounds great, but what does that mean? Industry by industry, it's quite different. It's a lot harder for somebody in fossil fuel that's maybe in a mine or on an oil rig versus somebody who sits behind a desk. I'm going to go quickly because I want to keep us on time, but motivations are wide ranged in the industry. But what I will tell you is the greatest motivation has been the financial results of incorporating these criteria and data points. And it's pretty compelling. I won't get into any slides that show it, but I want to relay this to those of you that have been in the space for a while. How many folks here are familiar with the social, what was once the Domini Social Index? It's now the KLD Social Index. So quite a few names, hands in the room. I was just looking this morning. There is because it is 400 companies based in the United States that have, for a long time, scored better in either the values proposition or now ESG criteria scoring. Substantial outperformance since 1990 versus the S&P 500, which most people think of the market. So, and the case is becoming more compelling. The numbers are actually pretty close till about 12 years ago, and now when you look, the bifurcation is becoming larger, and it may be because of an ability to uncover risk in ways that are not on traditional balance sheets. I don't want to say for sure it's causation, but the signs are pretty good at this point. What we're seeing is asset managers that were not thinking about the social responsible investing world are now coming in, first of all, to meet mandates. If you want to have your fund included in a particular organization, you're going to have to answer some questions. Do you do this? Do you do it on a serious level? How long have you incorporated this new piece of your business? And then further, we're seeing results, and I think that probably matters more than anything. So I want to share with you a report that USIF has put together since the mid-90s. It comes out every 2 years in the fall at the end of an even year. It is not an exciting name, but the Trends Report, but it gives you a sense of what's happening in the United States in our space. And the numbers are pretty staggering. So look at the hockey stick really starting from 2012 to now. Essentially, what has happened is what was something for particularly interested individuals or organizations has now become very much the mainstream, potentially could be described as inevitable. But we've reached a point now where 1 in 4 professionally managed dollars in the United States are now incorporating ESG into the investment process. That is huge, and that wasn't true a decade ago. really wasn't even true 5 years ago to the extent that we're seeing now. For US SIF, that's exciting. It means our universe is growing, but then it also means we have to figure out what are the coming trends and where are areas of interest and or risk or threat to the people that care about investing this way. And so I want to show this one piece because it gives you a sense. So you've got $12 trillion now in the United States invested more responsibly. I don't want to say universally responsibly, everybody's a little different, but more responsibly than before. Not that many people are engaging, and I believe that is the next wave. So you have seen a lot of the companies now in the S&P 500, so the largest companies in the US, are putting together corporate responsibility statements and reports each year that you can access and even see some of the ESG data point and criteria addressed. On top of that, you've got activists, either on the individual level or on a fund ownership level, approaching companies and saying, hey, we have to own you, or we do own you, and these are areas of concern and we want to fix them or address them, or at least make sure you're aware that we're thinking about them, because we might not own you if you don't address them. And there's obviously a lot of room to grow. Not everybody's doing it, and then even those that are doing it, very few are even reaching the point of taking it to a shareholder resolution, which is sort of the final frontier of engagement. I'm going to jump quickly to why people are doing this. I mentioned performance. I want to show you two quick studies that for those of you who maybe are wondering why is the industry writ large just accepting that this should be done. And it is because the majority of studies that are being put out now, they are public and private partnerships, academic studies, asset managers putting these out, are all finding that in pretty much the worst case scenario, it's not a negative event on your return stream. There was certainly a period of time where the only investors doing this were potentially divesting, and there may have been stretches where tobacco did particularly well and those that divested then actually had less performance. But we're finding now that the reverse is showing itself to be true, at least in shorter term periods, and that there are more professional approaches to divestment, and there are different ways to advocate for change within a corporation, hopefully all for the betterment of society. And so there are studies, you can find these, they're all public, so they're not hidden anywhere. But I wanted to make sure that you know that there's a lot of science and academic study and rigor behind the data points that this is improving. So real quickly, active shareholder strategies, and then the people that really know about this will be on stage shortly. There's a couple ways to view what engagement means. Voting proxies, if you're a shareholder, that's pretty self-explanatory. Letter writing is sort of the next level. That's saying like, hey, I see an issue, I want to talk to the company, I hope they respond. They don't always. Right now, even an individual who has only owned the company for 1 year and $2,000 worth of that company can engage. And they're trying to change the rules to you have to have 1% of the company for 2 years. And that is a big problem in the estimation of US SIF, because you're going to have basically 3 entities that could even talk to Amazon. And that's problematic. So that's what we're fighting for on the policy side. There's a coalition working on this, but it's scary because if it would change, it really changes the ability for active investors who have thought about this for a long time to address issues directly with the companies that have those issues or might face them if they're not addressing them. So to an extent, your size will be the reason why they respond to you, but most corporations now actually have people in the role to take these questions on, to shoot out reports and answers. But the last level, which is these shareholder resolutions, is if you're getting no responses or they're not addressing what you're saying, you can bring it to vote with the other shareholders. And you get, if you file it, the mechanics of it are you only have 500 words. If it's 501, they can throw it away, it doesn't matter. But you have 500 words to describe the issue, and you must read it aloud at the annual shareholder meeting. And then there's a vote. And essentially, if you get 3%, you can bring it up next year and the year after that. But the point is, this is currently, there's a threat to this, and we don't want it to change. So for people working in the space across the spectrum, even asset managers that are very large wouldn't be able to do this. So there are concerns, large and small, about what this could mean. I just want to share this last slide before handing it off to the panel to talk about it, but we're seeing more and more proposals succeed. The caveat to this is even if it wins, even if you get the 50 0.1% majority, the board doesn't have to take action. They're just aware that you care. So it's a non-binding event. But what is exciting is we are seeing more and more attempts succeed. More and more shareholders are engaging. Firms are hiring, which is also under threat, proxy voting services who can do this on your behalf to align with the things that you would like to see happen. But if there's a takeaway here, it's that the world's becoming more engaged. And even the investors who maybe wouldn't have considered themselves socially responsible investors are now being pulled in for various reasons. They may just care about environmental issues and so now fall under the sustainable umbrella. Or they were only worried about their individual communities and worried about maybe development bonds to rebuild housing or resettle refugees or whatever the issue might be. And those impact investors are now, they were probably always aligned with the SRI pioneers, but now find themselves with a unique voice within the space. And then the responsible investment space is this falls on what I would call traditional asset managers. If they're not paying attention to ESG issues, they are not uncovering potential risks, and those risks can manifest themselves in various ways. Data breaches are common, but if a manager was paying attention to ESG data, they would have noticed that there were some problems with, let's say, Equifax. And most funds that used ESG criteria, and I think when I say most, it was 97 out of 99, didn't own Equifax before the data breach that led to a very large stock price drop. It's not, it's not perfect. There are going to be misses, but the point is those that maybe weren't doing this before are now incorporating ESG to some extent because they recognize their old models aren't uncovering risks, especially in the intangible space. So my takeaway to all of you is the really great news is this is happening. This is happening. This is not just the socially responsible investors that have done this for a long time. This is happening across the country. So we're excited that there are, of course, leaders in the field and people that are bringing issues to the surface and essentially forcing companies to, if nothing else, think about them. But thank you very much, and I'll be back for the Q&A later.